Okay, so I'm about 8. So good morning and welcome to this AVC Wise hosted webinar for local government pension scheme and shared cost AVCs. My name is Ian Addison. I'm one of the retirement education specialists at AVC Wise, and I've worked in financial services for over 35 years. And prior to joining AVC Wise, I worked for Prudential for 7 years. Prudential being one of the main providers of AVCs within the local government pension scheme, and no doubt for many of your good selves. And during that time, I've assisted thousands of members like yourselves in retirement early and or with more money. And today I'm going to give you an overview of your main local government pension scheme, the benefits that it brings you, how your pension is calculated, and also the fantastic employee benefit that's available to you, namely the Shared Cost AVC. Please note that today's webinar is factual only. It does not constitute financial advice. Any information that I run through is based on our current understanding of taxation, legislation, and scheme rules. Levels, bases, and relief from taxation are subject to change and treated on an individual basis. And in respect of the investment funds, remember that values can go down as well as up, and past performance of those funds should be taken as an indicator of how they may perform in the future. So what are we going to be looking at today? Well, first of all, I'm going to give you an overview of your local government pension scheme, how your benefits are calculated, and really give you an insight into what is really a very good pension scheme that you have. Next, I'll introduce you to our fictitious local government member, Sarah, and see how her retirement benefits have accrued across 3 different sections of the local government pension scheme. Looking ahead to that time, or when you do retire, obviously that's a really important time or chapter in your life, and I'm sure we would like that to be as enjoyable as possible. So we're going to have a look at what options you have in increasing your retirement benefits to help you achieve that lifestyle that you want to live. Next, we'll have a look at the unique opportunity that is available to you, the Shared Cost AVC, and why it's an employee benefit that can really make a difference to your future retirement needs. When you get to retirement, how do you access your AVC and what options are there for you in terms of the decisions that you need to make? And finally, if you're not currently already making AVC contributions, how do you start the process? Very straightforward indeed, and I'll explain what that looks like. So let's start by taking a look at your main local government pension scheme. Now, as I said just now, your local government pension scheme is a really good scheme. A lot of people would swap places with you because it has a number of significant benefits and features, some which you may be aware of, others which you may not. So first of all, it is a really secure scheme, so you don't have to worry that your pension isn't going to be there for you when you retire. The government guaranteed to pay that to you. Now, that guaranteed income that you'll be receiving will be paid on a monthly basis. So if you spent your whole working life being paid monthly, well, the good news for you is that that continues into retirement as well. Even better still is the fact that your pension is paid for life, so it doesn't run out after 20 years or anything like that. It carries on even if you live to over 100 years of age. Now, at a time when cost of living is very much in our daily news, then the reassuring knowledge for you is that your local government pension increases in line with inflation. So news is measured against the CPI, the Consumer Price Index, meaning that the true value of your pension is not diminished by external economic factors. Assuming you're a taxpayer, well, the good news is that you'll get tax relief on your contributions at source, and that's all done through your payroll. You don't have to contact HMRC, fill in any forms, that's all done automatically for you. So effectively, you're saving money from the outset. Now, hopefully you won't need to avail yourself of this feature, but you do have that peace of mind that if you were unfortunate to pass away before retirement, then a death grant of 3 times your pensionable pay goes to your nominated beneficiary. And also a survivor's pension of up to 50% of your pension is paid out to your spouse, cohabiting partner, and in certain instances, eligible children. Shouldn't be underestimated how much your employer is actually paying into your local government pension. In some instances, that could be as much as 20% of your salary. Now, if you're at that age where maybe you're thinking of slowing down, maybe taking their pension benefits and then returning to work maybe on a 2 or 3 day a week basis, flexible retirement might seem an attractive proposition. However, please note that your employer does not have any contractual obligation to agree to any flexible retirement request. So if it is something that you're thinking about, I would suggest that you speak with your payroll first. Now, if money was really difficult, but you considered actually opting out of the local government pension scheme altogether, there is an alternative to that, known as a 50-50 section, whereby you pay 50% of the amount into the pension and get 50% accrued of the pension itself. Now, that's an alternative to opting out, and what that means is that you can then retain any life cover or ill health benefits that you may have. Talking of ill health, again, if you were unfortunate enough not to work through ill health, again, you have that reassurance knowing that your pension is not going to be adversely impacted as a result. Now, it does require 2 years membership within the scheme and is also subject to medical confirmation. And any of you who have membership in the local government pension scheme prior to the 31st of March 2009, well, the good news for you is, as well as receiving your pension at retirement, you'll also be receiving an automatic tax-free lump sum as well. So when you look at all those benefits, it's a really great scheme, but have you considered how your pension is calculated, what it may look like, and probably most important of all, whether that's going to be sufficient to support you in retirement? Now, all of you today will be members of the care section of the local government pension scheme, the career average revalued earnings section, which came into force on the 1st of April 2015. Now, this is calculated quite simply that every year, 1/49th of your salary is banked as pensionable income. So, for example, if you earn £49,000, £1,000 would be banked. If you earn £24,500, £500 would be banked. So every year, 1/49th of your salary goes towards your annual pension at retirement. Now, those amounts, as I said, are linked against the consumer price index, meaning that the true value isn't diminished over time. And when you get to retirement, all of those amounts, those yearly contributions into your pension are added up, and that would determine what your annual pension is when you retire. Now, prior to the current care section, there was another section of a local government pension scheme, a final salary one, which ran from the 1st of April 2009 to the 31st of March 2015. Now, this is a little bit different to the 49th insofar as how this is calculated. For every year's service in the scheme, 1/60th of your final salary is banked as pension. So, for example, if you worked for full 6 years, effectively that would equate to 6/60ths of your final salary going towards your annual pension. If you worked part-time during that time, so let's say you only worked 50% of the hours over those 6 years, then effectively that would equate to 3/60ths. And prior to that final salary section, there was another final salary section which ran up until the 31st of March 2009, worked in a very similar way, although not quite as generous insofar as for every year's membership, 1/80th of your final salary is banked towards your annual pension. And in addition to that, as I mentioned just now, you'd also be receiving an automatic tax-free cash lump sum. Now, some of you may have membership across all 3 different sections of those schemes, and when you get your pension statement, you may well see it broken down into care benefits and final salary benefits. Well, effectively, care relates to any pension that you've built up since the 1st of April 2015. Obviously, for final salary benefits relate to service prior to that date. Now, what we're going to do now is introduce you to our case study, Sarah, who has membership across all 3 different sections shown here in terms of a local government pension scheme. So Sarah has a normal retirement age of 67, and at that point, her final salary is going to be £29,311. Now, Sarah's had 1 year's membership in the 80th final salary section, and you see that that has accrued her just under £400 of annual pension, and also an automatic tax-free lump sum of £1,106. Sarah also had the full 6 years in the 60th final salary section, and again, you'll see that those 6 years has accrued an additional £3,142 of annual pension. Now, looking forward and assuming there are no changes to the current care section, we're going to assume that by the time Sarah gets to 67, she would have completed 18 years in the current care section. And those 18 years has gleaned her an additional £10,742 of annual pension. Meaning that by the time she retires, Sarah's 25 years within the scheme, means she'll be receiving an annual pension of £14,277 and a tax-free lump sum of £1,106. Now, some of you may recall that when the current care section came into force, the goalposts moved somewhat in terms of when you can actually take your pension without incurring any reduction to it. So effectively, it means from 65 to 65 or your state pension age, whichever is the higher. So for some of you, that may be 66, it may be 67, may even be 68, effectively meaning you're going to have to work longer to take that pension without any actuarial reduction. Now, Sarah doesn't actually want to work until 67. She wants to go before that time while she has the good health to do the things that she wants to do. So what we're going to do now is have a look at the impact on those benefits should Sarah decide to do so. So Sarah actually wants to retire at 64, just 3 years, 36 pay days before her normal retirement date. Now, we've seen what she's due to get at that point, that pension of 14,277, that lump sum of just over 1,100. But what if she went at 64? Now, I'm going to have to accept that Sarah's pension is going to be less. First of all, because she's going to have 3 years less contributions, effectively 349s. And because she's taken it before her normal retirement age, there's also going to be some form of actuarial reduction to it. Well, if she went at 64, she would find that her pension dropped to 10,253 and also see a slight reduction in that lump sum as well. Now, that's a huge difference of over £4,000. Now, ask yourself, if you were in Sarah's position, would a pension of 10,253 be sufficient for you to do the things that you want to do and live the lifestyle you want to lead? Because clearly the lump sum that she's receiving isn't going to bridge that gap. And remember, that gap of £4,000 isn't just for the year that Sarah retires. It's for every single year that she lives into retirement, because your pension is paid for life and it is also index linked. So if Sarah lives 15, 20 years into her retirement, well, you could probably do the maths yourself. Now, generally, we don't save enough for retirement at a time when people are living longer. So what other options do you have in terms of retiring and boosting your income? Well, one of the options you have is additional pension contributions, APCs, whereby you are purchasing more pension within the local government pension scheme. Now, you have two ways of purchasing that. You can either pay by way of a lump sum, or you can make the repayments of that purchase through your salary every month. Now, if you make the purchase through your salary, you'll get tax relief at source. If you pay by way of a lump sum, any tax relief, effectively, you're going to have to claim back from HMRC. Now, you can buy a maximum of £7,050 of annual pension. Now, that amount effectively is increasing in line with inflation. So it does increase in line with inflation, as your pension does anyway. However, please note that if you were unfortunate again to pass away before retirement, that additional pension dies with you. So anything you built up in addition, that is not transferred in any form or relation to your survivor's pension or anything like that. The cost of the AVC will depend on a number of factors. So it will depend on your sex, your age, and how long you've got between now and when you're looking to retire. Effectively, the shorter the period between now and retirement, the greater the repayments will be. Also worth bearing in mind that if you're making those payments through your salary, it is a fixed amount we're going to have to pay between now and retirement. So if for any reason you weren't able to meet that payment, then the contract effectively would be cancelled. You've just accrued what you built up, And if you wanted to carry on, you'd have to start the process all over again. Now, there is a calculator on your local government pension scheme website in terms of the purchase of additional pension contributions. And generally, you would have to live for around 14 years into retirement to actually recoup the outlay and cost of them. So generally, there doesn't tend to be a huge uptake of APCs as a means of boosting your retirement income. Now, whatever pension scheme you belong to in the UK, you're currently allowed to take up to 25% of those benefits as a tax-free lump sum. Now, that's much more than what was allowed previously. And certainly any of you do have membership in the 80th section and are getting an automatic tax-free lump sum when you retire, that amount is unlikely to get anywhere near the maximum that you're allowed to have. So how to get more tax-free cash? Well, one of the options you have at retirement is to exchange some of your pension for tax-free cash. Now, the way it works in local government is on a exchange rate or commutation rate of 1 to 12. So for every pound of pension you give up, you'll receive £12 of tax-free cash. So if you choose to give up £1,000 off your pension, it means you get £12,000 tax-free cash. Now, that might seem very tempting. After all, who doesn't like tax-free cash? And you may well see on your local government pension scheme statement 2 sets of figures about your retirement benefits. One, which is the standard benefits, what you would get normally, but also an option to take a maximum tax-free lump sum. Now, that might seem very tempting when you see that figure, but also have a look at the difference in terms of your annual pension figure, because as much as you might want that tax-free cash, you've given up valuable index-linked pension in order to achieve that goal. Now, members in your scheme have seen their pensions increase by around 20% in the last decade alone. So giving up index-linked, paid-for-life pension at a ratio of 1 to 12 is maybe not such a great exchange. So wouldn't it be great if you could have both, build up a bigger tax-free cash lump sum, but not at the expense of your valuable pension in order to achieve it? So you could use the Shared Cost AVC, the employee benefit that's available to you, as the means to do that. Give yourself a bigger tax-free cash lump sum, but not reduce your pension in order to achieve that goal. Now, did you know that there's no other public sector pension scheme in the UK that allows its members to potentially take the whole of the AVC back completely tax-free? So members of the teachers' pension scheme, for example, the NHS, they do not have this option that you have. Now, there are some caveats to that, one being that you have to take the AVC at the same time as you take your local government pension, and there's also a limit to how much tax-free cash you can take. Now, if you don't know what that is, don't necessarily worry too much about that, because it's something we can always ascertain for you. The other great thing about the AVC is its flexibility. So unlike APCs, the additional pension contributions, if your circumstances change, you can change the amount that you're paying into it. So increase and decrease at any time. So you have that peace of mind that you're not setting anything in stone for the future. Now, whilst AVCs are available to all local government employees, not every employer offers the AVC on a shared cost basis. So the fact that your employers do is fantastic news for you, because what it means is not only to get tax relief, as you would with a standard AVC, but also saving in national insurance as well. Effectively, that equates to a double tax break. It doesn't really get it much better than that. Let's look at an example just to demonstrate the potential savings that you can make. Let's say that you wanted to pay £100 a month into a shared cost AVC. If you're an intermediate taxpayer paying 21%, what's that actually going to cost you from your take-home pay? Well, in actual fact, it would only cost you £67.12 from your take-home pay. Now, imagine putting £67.12 into an ISA and immediately seeing it turn into £100. Yes, you could access the ISA immediately with the AVC. The earliest you'd be able to do so currently would be from the age of 55. However, by the same token, if you've got money sitting in a building society or bank account, are you really getting that return? Imagine walking into your building society with £67.12 in your hand, walking straight back out the door with £100 in your hand. Well, in order to achieve that, you would be looking at a return of 48.98%. Now, that's an amazing return. Now, when you walk down your high street, have a look in the windows of those banks and building societies and see if you can get anything remotely close to that. That's an amazing opportunity for you to save in the most tax efficient way through this employee benefit. Let's take this a little bit further just to demonstrate this. So you've met Sarah. Let me introduce you to Joe. Now, Joe earns £30,000 a year and previously wasn't really making any provision for his future retirement needs. The only provision effectively he's making is the amount which goes into his main local government pension scheme, which is based on a percentage of his £30,000 salary. And you see in Joe's case, that amounts to £149.68. You'll also see Joe is paying tax of over £260, national insurance, a sizable amount again of over £174, leaving his take-home pay at the end of the month just over £1,915. Now, Joe bumps into Sarah, and Sarah tells Joe about her desire to retire early, how she's going to use the Shared Cost AVC to help her achieve that goal, and also tells Joe about the savings she's making every single month with respect to tax and national insurance savings. Now, Joe goes home and reflects upon what Sarah says and thinks, well, that clock is ticking along. I can't slow that down. And before I know it, retirement will be looming for me. So really, I should be taking advantage of this employee benefit to really give myself more options and potentially a better lifestyle when I do retire. So what Joe then does is to pay £250 into a Shared Cost AVC. And as a result, his payslip then looks like this. Now, the first thing you'll notice is that Joe's gross monthly pay has gone from $2,500 down to $2,251. Now, some of you may be thinking, well, maybe that's not a smart move by Joe, because by doing so, no doubt he's damaged his valuable local government pension. But the good news is that Joe hasn't damaged his local government pension benefits. So for those, any pay rises, etc., his employer will still use the pre-sacrifice salary of £30,000 for those benefits. You'll see that that's borne out by the fact that Joe's contribution into his main local government pension scheme, based on a percentage of that £30,000, is completely unchanged, £149.68. Now, the nature of the Shared Cost AVC means that contributions need to be made on a shared or joint basis. So Joe needs to make a nominal contribution of £1 per month, and upon that, he'll receive tax relief. On his behalf, his employer will forward a £249 that he has sacrificed, and upon that, he'll receive tax and national insurance savings. So his total contribution at the end of the month, £250. You'll see his tax has gone down by over £52, his national insurance by nearly £30, meaning his take-home pay at the end of the month, £1,747.20. So Joe's £250 into the AVC has in fact only cost him £168.02 from his take-home pay. And that's purely as a result of a tax and national insurance savings that he's made. I think the figures there speak for themselves. So what happens to Joe's £250? Well, the only way that you can pay into a Shared Cost AVC is through your salary each month. You have no other way to do so. So you can't do a bank transfer. You can't write a check. It has to go through your salary. So each payday between now and when you're looking to retire, however far away or near that may be, should be seen as an opportunity to make a difference. Remember, you've got that great flexibility to change your contributions at any time, increase and decrease as your circumstances dictate, anything from £2 a month up to around 60% of your salary. Now, the money that you pay into the AVC is then invested on your behalf, and the company responsible for that, depending on the employer, may be Prudential, it may be Standard Life. You may even have a choice. So the idea is, as well as getting those tax and national insurance savings every month, you also get some investment growth as well. Yes, it is an investment. Investments can go down as well as up, as I mentioned earlier. However, you have complete control over where your money is invested. So effectively what you're going to have is a range of funds which have different levels of risk to choose from. So you can decide to take as much or as little risk depending on your own attitude towards it. And again, you can change that any time. You also have that great flexibility at the point of retirement. So you could use the money that you build up within the AVC as the means to give yourself further income in retirement by way of an annuity, for example. However, you have this unique option whereby you can take the whole amount back tax-free and do what you like with it, whether that's buying a new car, go on that dream holiday, it's entirely down to you. Now, in respect of those investment funds, as I mentioned, you're going to have different levels of risk. So they range from minimal risk up to higher risk. You can split your investments across different funds and diversify it. You may also have a default fund. So a default investment option is something that you could choose yourself, but it's been made available by the trustees of your pension fund, the people who maybe don't want to make an active decision or struggle to do so. It's not a recommendation in any way, but it's there for that purpose. You may also have a lifestyle option. So a lifestyle option is which is mainly aimed at long-term growth, whereby the fund changes in terms of its risk level as you approach retirement. The only charges that you're ever going to pay in respect of the AVC are the annual management charges to the provider, which for Prudential are typically between 0.55 and 1%. Standard Life tend to be in excess of 1% and may be deducted automatically. But remember, you have that flexibility to change those at any time, as many times as you like. Now, talking about that flexibility, hopefully life is one long journey and road. And along that journey, lots of things can happen, some which we can anticipate and others which we can't. And certainly recent years will have shown that to its fullest extent. So it's important to understand that whilst you have that flexibility of the shared cost AVC, it's important to remember that no matter how near or far away your retirement is, it's still important to make it a difference to it. So if your retirement is, say, 20 odd years away, you may be thinking, well, I don't know whether I'm still going to be working in local government then. It's a really much point in me paying into something when I don't know where I'm going to be in 20 years' time. Or you may be saying, well, I can only afford a relatively modest amount at the moment. That's fine. If I tell you my very first job, I won't tell you how long ago it was because you might not believe me. But my very first job, I earned £3,750 in my first job. My employer put around about £20 a month into a pension for me. Pensions weren't on my mind at all. They seemed light years away. I was too busy out with my friends enjoying myself. So I was only there for about a year or so. So my employer put £20 a month into a pension for me. The last time I looked, that pension was worth over £12,000. So my point being that if your retirement is a long way off, or maybe you can't afford, you can only afford a relatively modest amount, it all adds up and makes a difference, at your point of retirement. So it's also important not to lose sight of that fact. By the same token, if your retirement is, say, 6 months away, you might be thinking, well, this sounds great. However, 6 months isn't really going to make a difference, is it? And I probably left it too late to make a difference. However, if you're in a position where maybe you have paid the mortgage off, you haven't got kids phoning you up asking you to bail them out every 5 minutes, or maybe you've got money sitting in a builder society from an inheritance or something like that, which isn't really doing a great deal for you, you might be pleasantly surprised how much difference you can make in a relatively short space of time. So my point being that it's never too early or too late to make a difference to your future. Now, looking ahead to that time when you retire, what options do you have? So from the age of 55, remember, you've got that potential to take the whole of the AVC back completely tax-free and do what you like with it. You may decide to use that money to purchase an annuity by giving yourself a guaranteed income for life, or you may even decide to approach your employer and purchase more local government pension itself. You may even decide to do a combination of those things. It's entirely down to you. Now, obviously, if your retirement is some way off in the future, then you don't have to worry about it now. But if you do want to talk through your options, so if you're over 50, so if you've been on a saga holiday or looking at our brochures, you can contact PensionWise. You'll see their details at the bottom. Go on to the moneyhelper.org website. They're not going to give you advice, okay, but they can talk you through your options in terms of what you can do at that point of retirement. It is a government service. It's completely free of charge. So let's go back to Sarah and see her situation. So remember that she was due to get that normal pension age, that pension of 14,277, that lump sum of just over 1,100. And we saw what would happen if she went at 64, leaving that gap of over £4,000. So what Sarah will look to do, if she has the time and resource to do so, is to pay into a shared cost AVC and use that to bridge the gap between retirement at 64 and taking her local government pension without that actuarial reduction at 67. So let's have a look how she may do this in the most tax efficient way. So we're going to assume that by the time Sarah gets to 64, she's built up £48,000 in the AVC. At 64, she leaves her job, but doesn't take her local government pension. She does, however, withdraw £16,000 of the £48,000 which she built up to that point. Now, normally she's allowed to take 25% of that withdrawal as a tax-free cash lump sum. So in this instance, £4,000. The balance of £12,000 would normally be deemed as taxable. However, if Sarah has no other income, that £12,000 effectively is below the standard personal allowance of £12,570 in terms of the amount everybody's allowed to earn before they start paying tax. So what Sarah does is then contact HMRC and advise them accordingly. So she doesn't end up paying tax on that £12,000 either. So she's taken out £16,000 and paid no tax on it. She waits until the 6th of April the following year, new tax year, and does exactly the same again, and then the year after that. So by the time she gets to 67, she's withdrawn the £48,000 she'd originally built up, paid no tax on any of that, and is then in a position to take her local government pension without that actuarial reduction. And of course, at that time, she'll also be in a position whereby she takes her state pension as well, and of course will then pay tax again. Now that's a really great example of somebody who needs their shared cost AVC to help them retire early and bridge the gap. So in terms of those lump sum options, so based on Sarah's local government service, her pension of £10,253 means that she had potential to take up to £68,350 as tax-free cash lump sum, so effectively 25% of her benefits. As she was receiving that automatic tax-free lump sum from the 80th section, it meant that she had scope in her AVC to build up to £67,294. So that's a quite considerable amount of money that Sarah would have had. Now, obviously, if she'd have actually bit a bullet at 64 and taken a hit on her pension, and she had £48,000 at that point, when obviously she could have taken that in one go, completely tax-free, because it was below that limit of 67,000. So just to summarise the main things that we've run through today, remember the local government pension scheme is the only public sector pension scheme that allows you to save in this way. The fact that your employers often view this as an employee benefit is fantastic news for you, because what it means, not only do you get tax relief on your contributions, but also national insurance savings as well. And then you have that potential to take it all back complete tax-free at retirement. So again, if any of you can think of a more tax-efficient way to save for retirement and get that return elsewhere, do let me know. Now, as always, there are some considerations to bear in mind. First of all, you have to be a member of the main local government pension scheme to pay into this. So if you're not paying into your main scheme, then you can't pay into the shared cost AVC. There are some national minimum living wage requirements, just effectively meaning there's sufficient money in the tank at the end of the month. Don't necessarily worry too much about that, because it will be something checked upon submission of any application. There's a lower earnings limit of £6,396, which if you went below could damage your state pension. Now, two things on that: most of your employers won't actually allow you to go down to that level. And even if they did, ask yourself why you would be doing so, because again, at that level, you're below the standard personal allowance of £12,570, the amount everybody's allowed to earn before they start paying tax. And if you're not paying tax, well, guess what? You're not getting tax relief on your contributions either. So it begs the question why anybody would want to do so. Some government limits to note: the annual allowance is how much the government allow people to pay into pensions each year. So that includes your local government pension, the AVC, any other pensions you pay into. That is £40,000 a year, 40. If you have accessed personal pensions or money purchase pensions in recent years, taking money out of them or withdrawn them, or maybe thinking of doing so, you might want to familiarise yourself with the money purchase annual allowance, the MPAA, as that may seriously restrict what you could then pay into similar pensions going forward. The MPAA is £4,000 a year. Now, the provider will have notified you in writing if you've taken any money out of such pensions at that time as to whether you trigger the MPAA. The lifetime allowance is how much you can build up in your pension plans before punitive tax charges apply. So it's the actual value of those pension plans and pots, includes any deferred pensions. That is currently £1,073,100. Might be quite a nice problem to have if your pensions were valued that high. Remember, you've got flexibility to change the contributions at any time, increase and decrease as your circumstances dictate. And if you opt out of a scheme or leave local government employment, it just means that you won't be able to pay into it anymore. Any money within the AVC will remain invested, hopefully still grow at that time. It just means you won't be able to add to it. So if you see this for what it is, a really fantastic opportunity to make a difference to your future retirement lifestyle, how to go about applying? Well, simply all you need to do is go to the AVC Wise website and click the new application button. If you're currently making a standard AVC contributions whereby you're just getting a tax relief, just click on the Convert button. Enter your personal details and decide from the fund guide available from your provider where you want your money invested. Your employer will then verify that application, and you'll also be able to set up an online account with the investment provider. And participation in the scheme itself will take effect from the next available payroll. If you're currently already making shared cost AVCs, remember you've got that flexibility to change the contributions at any time, increase or decrease as your circumstances dictate. Again, very straightforward to do so. Just log in, head to the My Shared Cost AVC page and enter the new amount you wish to go into the AVC. Again, your employer will check the application, and again, it will take effect from next available payroll. Now, I appreciate sometimes people might just need the I's dotted and the T's crossed, or maybe just want to know what scope they have in, really maximising the potential of this employee benefit. One of the ways which we can help you is by offering you a one-to-one meeting via Microsoft Teams. So some of the things which we can do at that meeting is, based on your service within the local government pension scheme, calculate what's the maximum amount you could potentially pay in to the AVC and take that tax-free. Based on your salary, we can also have a look and see what's the maximum amount you can make on a monthly basis to really utilise those tax and national insurance savings. Remember, we can't give you any financial investment advice at those meetings. Now, there's a little bit of homework required before that time. So, look, first of all, have a look at your local government pension scheme statement, because that is the key document in terms of your retirement planning. It's the holy grail of your retirement planning, because effectively that's what telling you in black and white what you're going to get when you retire. So if you've got your statement and just put it back in the envelope and stuck it in a drawer, maybe now's the time to get that back out and have a closer look. Also, if you're like Sarah and look at that retirement age, projected retirement age or normal retirement age, and think, actually, I don't want to hang around until 67, I want to go before that time, then you should be able to get a projection to that desired retirement age yourself. So it's normally, if you go onto your portal where you can view your pension details, it normally comes under voluntary retirement or pension calculators. And effectively all you do is type your 60th, 64th birthday, whatever it may be, and it will recalculate those benefits for you. Yes, your pension is going to be less, but I also understand it's getting a balance. If you've currently got an AVC, have an understanding of how much is actually sitting there at the moment, and please have your most recent payslip. It's amazing how many people don't know what they actually earn. Further resources, as I said, that pension statement is the key document for you. And if you haven't got a paper one, again, you should be able to go online and have a look and see what the projected benefits are going to be when you retire. If you have queries about your main scheme, so if you want a little bit more detail on some of the main features I ran through at the start of the presentation, and you want to find out a little bit more information about that, your main local government website is the place to head for all those things. Do go to the AVC Wise Knowledge Hub. Why? First of all, there's a couple of really useful calculators on the website. One which will tell you what's the maximum amount you can pay into the AVC in any 1 month. So effectively, you just put your salary, how many hours you work, and your age, and it will tell you what that figure is. There's also one which will give you a projection of what you could potentially build up between now and retirement. Both very easy to use, both very easy to amend. But if you think about your affordability, it's a really good starting point to see the potential of this employee benefit. Also, I appreciate sometimes people might want to talk this through with their partner or other half. And let's be honest, pension's not the most exciting topic of conversation at the dinner table, even in my house. So what we've done is put a couple of short explaining videos on the Knowledge Hub that you can blitz watch Netflix style, cement your own understanding, and also get that message across to somebody else. Now, before I run through any questions that you have, if you need any further support after today, what does that look like? So if you would like one of those one-to-one meetings, all you basically do is email us at support@avcwise.co.uk, which effectively you'll be able to find a date and time for yourselves suitable to you. If you're on the website and you've got a quick query, you just want to check something very quickly during working hours, you can use the live chat facility. Similarly, during working hours, you can speak to our friendly customer services team by picking up the phone and dialing the number shown. The Knowledge Hub, as I've said, is a great starting point to get an understanding of the potential of this and really find out what scope you've got. If you have queries about the Shared Cost AVC, so pretty much any question that anybody's ever asked, you'll find that in the FAQ PDF document for your individual employer on the website. Pretty much everything will be covered in that document. Your main local government website is the place to head in terms of the benefits of your main scheme. And if you're into social media, then you can also follow us on Twitter or Facebook. We are also this week, tomorrow actually, 11:30, there is a Q&A session which we're running in conjunction with Money Week. You don't have to register if you want to go along. There is a link in the chat box. You'll find if you want to go along or listen or even ask a question, where a couple of my esteemed colleagues will do their best to cover all things AVC and local government pension scheme. Right, so let's see if any questions have come through. I think Claire is typing something, so I'll just wait for Claire's question to come through and endeavour to answer that for her. So if you have got any questions, now's your opportunity to ask that question, or subsequently, if there's something that you subsequently think of, you can always get in touch by one of the means shown there. But hopefully what I've shown you is that your local government pension scheme is a really fantastic scheme. It's got lots and lots of benefits, as you've seen. And if you've got long service within the scheme itself, then obviously, you know, those benefits will sort of magnify in terms of what you're going to be receiving at retirement. The fact that your employers are making this available to you as an employee benefit is fantastic news for you. It really is the icing on the cake for you. Okay, so Claire said, you said something about teachers and nurses. I am a teacher and I'm looking to invest. Is this still possible? If you are a teacher, Claire, you can't pay into a local government AVC. So you will have an AVC facility through the teachers' pension scheme. I know that because Prudential were looking after teachers' AVC. So you will have an option to pay into an AVC, but not a shared cost AVC, Claire. So just double check. I'm sure you know better than I do, but just double check that you are actually paying into the teacher's pension scheme. If that's the case, you can't pay into this, unfortunately. But as I said, you will have an AVC facility, but not on a shared cost basis. So just check with your main scheme in terms of those options. Okay. So I think that's the only question which has come in. So thank you for getting up early and listening to my dulcet tones. This really is a great opportunity for you, the ability to save in the most tax efficient way. And ultimately, the things which shape our lives are based on the decisions that we take and the choices that we make. Do make the right ones for yourself. Again, thanks for listening this morning. Enjoy the rest of this Thursday.